April 12, 2019. New York City. A company from Africa rang the opening bell on the New York Stock Exchange. Not a mining company, not an oil company, a shopping website. And not just any shopping website. They were calling it the Amazon of Africa. The stock opened at $14.50. By the end of that first day, it had gone up 70%. Within 3 weeks, it hit $49.99 per share. Investors were calling it the biggest African tech story in history. Journalists were writing that Africa's digital future had finally arrived. And then it all fell apart. Not slowly, fast. Within months, a man on Wall Street published a report calling the whole thing an obvious fraud. Lawsuits started flying. The stock crashed below $5. Countries were abandoned one after another. Thousands of workers lost their jobs. The founders eventually walked out the door. This is the story of Jumia, Africa's most hyped startup. And what really happened? The year is 2011. Lagos, Nigeria. Two French consultants from McKinsey are looking at a map of Africa and seeing something interesting. 1.2 billion people. A growing middle class. Millions of people buying things every day. And almost no organized way to shop online. No Amazon. No Alibaba. Nothing. Sasha Poignanek and Jeremy Hodara looked at that gap and decided to fill it. They had two Nigerian and Ghanaian co-founders with them, Tun Kahind and Raphael Offeder, who understood the local market. And they had the backing of Rocket Internet, a German company whose entire business was taking successful Western tech ideas and launching them in developing markets before anyone else could. The idea was simple: build Amazon, but for Africa. In 2012, Jumia launched in Lagos. 10 people, a small warehouse, a website selling electronics and fashion. Within the first year, they expanded to Egypt, Morocco, Kenya, and South Africa. By 2014, they were in 14 African countries. The money was pouring in. MTN put in money. Goldman Sachs put in money. AXA, the massive French insurance company, put in money. Orange Telecom put in money. By 2016, Jumia had a valuation of over $1 billion. Africa's first tech unicorn. That was the headline everywhere. But here's the thing nobody wanted to say out loud. Building an e-commerce company in Africa is not the same as building one anywhere else. Not even close. Let's start with the most basic problem. Most Nigerians and most Africans do not have a credit card or bank account linked to an online payment system. So how do you run an online shopping site when your customers cannot pay online? Jumia's answer was cash on delivery. The delivery person brings the package. The customer pays cash at the door. That sounds simple. It is actually a nightmare. Because now you have thousands of delivery people carrying cash across cities like Lagos every single day. Managing that cash is expensive. Losing that cash is easy. Then there is the address problem. Most Nigerian addresses do not work like addresses in London or New York. There is no clear street numbering system in many areas. A delivery instruction might say, "Third house after the big mango tree. Turn left at the blue gate." Finding that house costs time. Missing that house costs money. Then there is the return rate. When customers could not see or touch a product before buying, many of them would order, receive the item, look at it, and send it back. In 2019, Jumia's own numbers would reveal that 41% of orders were either returned, not delivered, or canceled. 41%. For every 10 orders Jumia processed, 4 of them never actually became a real sale. All that logistics cost, all those delivery attempts, 41% came back. That is not a business problem. That is a structural crisis. And Jumia was spending enormous amounts of money, losing hundreds of millions of dollars every year, while all of this was happening underneath the surface. By 2018, Jumia had raised nearly $600 million from investors. But they were still losing money. A lot of it. And the investors who had put money in MTN, Rocket Internet, Goldman Sachs, they all wanted their return. The fastest way to give them that return was a stock market listing. Go public. Let investors buy shares. Cash out. On March 12, 2019, Jumia announced it was listing on the New York Stock Exchange. The hype was enormous. Africa's first major tech company on a global stock exchange. The Amazon of Africa. The future of 1.2 billion people arriving on Wall Street. Morgan Stanley and Citigroup led the deal. April 12, 2019. The bell rang. The stock launched at $14.50. And in the very first hours of trading, it shot up. By the end of day one, up 70%. Within 3 weeks, $49.99. Jumia's total market value hit over $3 billion. The founders were celebrated. The investors were celebrating. Africa was supposedly arriving. Then came May 9th, 2019, 27 days after the IPO. A man named Andrew Left, who ran a firm called Citron Research, published a report. He called Jumia an obvious fraud. In 18 years of doing this, he said, he had never seen anything like it. His claim was specific. He had obtained a confidential investor presentation that Jumia had shown to private investors in October 2018, 6 months before the IPO. When he compared those numbers to what Jumia put in their official NYSE filing in March 2019, the numbers were different. 600,000 fewer active customers, 10,000 fewer active merchants. He said Jumia had inflated its customer numbers by 20 to 30% to make the business look more attractive before the stock market listing. He also pointed to the 41% return and cancellation rate, a number Jumia had buried in its filing but never highlighted to investors. The stock fell 14% that same day. Then it kept falling. Investors started filing lawsuits. Multiple class action cases in the United States claiming Jumia had misled them. The stock that had hit $49 was now at 28, then 18, then below 10, then below 5. By the end of 2019, Jumia's stock had fallen more than 80% from its peak. People who had bought in at the height of the hype had lost most of their money. And it wasn't just the stock price. The business itself was in serious trouble. Jumia exited Gabon, then Cameroon, then Tanzania, then Rwanda, then Zambia. Layoffs in Kenya. Layoffs in Nigeria. Layoffs across the continent. The two Nigerian and Ghanaian co-founders, Tund Cahind and Raphael Offiter, had already left years earlier, barely 2 years after founding the company. And now Jumia was shrinking fast. Here's a question that kept coming up throughout all of this. Is Jumia actually an African company? It was founded in Lagos. It serves African customers. It employs thousands of Africans. But the two men running it were French. The company was incorporated in Germany. Its corporate headquarters were in Berlin and later Dubai. Its senior management team at the time of the IPO had almost no African faces in it. When Citron Research published its attack on Jumia, they specifically called it a Nigerian company. Jumia's defenders said that was unfair. The company operates across Africa for African people. But its critics pointed out that the people making the decisions, taking the salaries, and holding the largest share of the stock were mostly European. And when things went wrong, it was African workers who lost jobs. African vendors who were left with unpaid balances. African customers who lost trust. A former employee described the company culture this way. Everything was about copying Amazon. The font on the website was copied from Amazon. The color scheme, the product layout, even the internal culture, the worship of numbers at any cost, the pressure to show growth metrics, was imported directly from Silicon Valley. The problem is that Africa is not Silicon Valley, and Lagos is not Seattle. What works in one place does not always work somewhere else. November 2022, 3.5 years after the IPO. The two founders, Jeremy Hodara and Sasha Poignanec, stepped down. A new CEO came in, a man named Francis Dufay, who had been running Jumia's Ivory Coast operations. And Dufay did something the previous leadership had resisted for years. He stopped trying to be everywhere. He started cutting ruthlessly. South Africa gone. Tunisia gone. Algeria gone in early 2026. He reduced the number of countries from 14 down to 8. He cut headcount. He reduced the cost per delivery. He renegotiated supplier contracts. And for the first time in Jumia's existence, the losses started getting smaller. Not gone, but smaller. In 2022, Jumia was losing $191 million per year. By 2025, that loss was down to $61 million. Revenue grew 34% in the final quarter of 2025 to $61 million. In Q1 2026, revenue was up 39% year-on-year. GMV, the total value of all goods sold on the platform, hit $211 million in just one quarter. The stock, which had fallen to a low of $1.60, recovered to above $12. The company is saying it expects to break even by the fourth quarter of 2026. Full profitability in 2027. Those are targets, not guarantees. Jumia has missed targets before, but the direction is finally the right one. So what do we actually take from the Jumia story? First, the hype around African tech was real, and it was also dangerous. When investors in New York hear the words Africa, 1 billion people, and e-commerce in the same sentence, they get excited. That excitement is not always matched by understanding of what it actually costs to deliver a package to a house with no proper address, in a city with bad roads, to a customer who wants to pay in cash and might return it anyway. The gap between the story and the reality was enormous. And Jumia sat in the middle of that gap and kept spending money. Second, growth at any cost is not a strategy. It is a way of hiding a problem. For years, Jumia kept expanding into new countries, hiring more people, and processing more orders, while losing more money every year. The numbers looked big. The business was not healthy. Third, and this is the most important one, the question of who an African company actually serves matters. A company can operate in Africa, employ Africans, serve African customers, and still make decisions that prioritize European and American investors over the people on the ground. That is not unique to Jumia. It is a pattern that repeats itself across this continent. The real question is, who is building African tech for Africa? Who is making the decisions? Who stays when things go wrong? Those questions do not have easy answers, but they are the right questions to ask. As of 2026, Jumia is still alive, still operating, still trying to become the company it always said it was. Whether it finally gets there, that story is still being written. If this got you thinking, subscribe to Africa Inc. We tell the real stories, not the hype, the real thing. Next episode, Flutterwave, the Nigerian fintech that raised nearly $500 million and became the most valuable startup in African history. And then the lawsuits, the allegations, the controversies that followed. That story makes Jumia look calm. Subscribe. You don't want to miss it.